एक्सचेंज ट्रेडिंग कर रहे हैं, जो कि सभी लोग कर रहे हैं।
Coaching is now starting from grade 3, 4, 5, 6.
होता जाने वाली बीच राह में आधे टेस्ट देके हैं सिलेक्शन की चाह में।
ऑल इंडिया का बच्चा कोटा जाता है।
This rat race is for rats, not for humans. So why should we even be a part of it?
The Rat Race. This and more streaming on world's first news OTT, News 9 Plus. Download now.
He thought he could outlast us. And 1 year later, the evidence is right here in this room.
Who will blink first?
So far from preventing the expansion of NATO, Russian actions have actually resulted in the expansion of NATO.
It's a mess for Russia and it's a mess for the Western world, for NATO and the United States.
Putin is a dictator, and if he loses, that means the end of his regime, and probably of him personally. So he has to keep going.
Year 2. No end in sight. Streaming now.
Hello and welcome. You are watching Business Plus here on News 9 Live. I'm Krishna Kumar, and joining me in the studios for the afternoon edition of Business Plus is my colleague and friend Suyash Maheshwari. And as always, we begin the afternoon edition with a check of how India's stock markets closed the day's trading session. Suyash, talk to us. Markets opening flattish, but not really having a good trading session after that.
Not having a good day at all, Krishna. The markets collapsed and they crashed by about 1% in today's trade. Now, some volatility was expected given that today was a futures and options monthly expiry, but this kind of crash was not, something that the market was expecting. But given the global cues, then again, we can't really say, how the markets will perform. Now, in today's session, at close, Sensex was down about 600 points or so. It managed to close just above the 65,508 mark, whereas Nifty not only, fell below 19,700, 19,600, it even briefly fell below 19,500. But, we saw some recovery in the last 15-20 minutes or so, and the index managed to close above the 19,500 mark, down about 0.98% in today's trade. Now, if you look at the broader markets, Krishna, the broader markets which were, largely mixed in today's morning trade, also succumbed to selling pressure. In fact, Nifty Mid Cap 100 was down about, 1.32% or so at close, whereas small cap index was down about 0.41% or thereabouts. And as I said, today was a weekly expiry. As a result, we saw a spike in volatility and,
clearly the India volatility index up nearly 11%.
Nearly 11% and above the 12 mark, which suggests that the volatility has increased significantly, compared to the last 30 days or so.
Right, and this is what you call as archetypically a sea of red as far as India stock markets. It's red all over the place. Broader markets, Nifty, Sensex, Nifty mid cap, small cap. There is no place to hide in these markets, is there? Is there a defensive play in these markets on a day like this?
I mean, if you're looking at the sectors, all of them ended with, major losses.
Okay.
In fact, the banking pack, which was actually, underperforming markets the entire past week, managed to outperform market. It was also down. It was down. The Nifty banking index was down about 0.64% in today's trade. The IT pack, Krishna, was the worst hit. It fell over 2% in today's trade. Now, among sectoral indices which fell over 1% is Nifty Auto. It was down about 1.17%. The FMCG pack, which again almost fell 2%, it was down 1.91% in today's trade. As I mentioned, IT pack was the worst performer. It was down about 2.19% in today's trade. The media pack fell about 1.4%. Metals corrected by 0.96%. Pharma PSUs also fell about 1% in today's trade, Krishna.
Right, that's the roundup of the day's trading session with Suyash. Suyash, of course, is going to stay on with us because we have a very special market guest joining us live on the show. We have Shahina Mukadam joining us live on Business Plus. Shahina, thank you so much for taking time out to be with us here on News 9 Live. What a day to join us for the first time. It's a sea of red on Dalal Street for the day.
Well, yes, and the thing is, we are at very important support levels. So, and also being, the last day of the expiry. So, I think a lot of things came together for us today. But I do think that, if we are able to sustain above these levels, then we may again see some bit of recovery going into next week. Because actually the stocks and the sectors that we saw today that actually pulled down the market were largely the defensive sectors, as we were discussing. The IT, you have FMCG, and some of the engineering and I would say some telecom companies did well. So to that extent, let us hope that there is support that comes over the next week.
As you mentioned, ma'am, the markets have been under pressure and perhaps support will emerge. What's keeping the markets down? Why did we see a 1% correction today?
Well, a number of factors. Actually, if you see the oil prices, crude oil prices, in closer to 3 digits is a very big, I would say, negative for the overall market. Now, this is over and above the other issues that are plaguing the, the global, as you know, there is a war going on, Russia, Ukraine. Also, there is an issue in terms of demand in Europe. Most of the companies which are having their markets, international markets of Europe and US are facing some bit of slowdown. Also in the domestic market, given inflation that has actually is remaining on the upper side and expected may slip further up, is keeping a pressure on demand even in rural areas. Petrol, diesel prices are at a very high level. Raw material costs are going up. So to that extent, all these things have come together in the very shorter term, which is why we've seen this correction. Not to say that the markets were cheap, So it's like markets also were expensive. So given this fact, we've seen this sort of correction.
Right, and especially, a lot of talk about how some mid-cap and small-cap stocks, have become overheated simply because of the buying interest that's been witnessed in them in the recent past.
Yeah, so if you see the mid-cap in the last 1 year was up by 35%. And if you compare this with the large caps, it was 15%. This is not to say that this sort of outperformance is normally mid caps will outperform large caps, but if you see the last 2 years trend, this rally has been far, it has been much faster than what was anticipated, and the valuations for the mid cap stocks. There's a small basket of mid cap stocks, especially which institutions can subscribe to and have in part of their portfolio. So those valuations have become pretty stretched. Like for the first time, it's becoming difficult to actually look and identify stocks which look reasonably attractive in terms of valuation, which look okay in terms of business prospects. I'm talking over the next, say, 6 months to 1 year. So it's becoming a bit difficult to find such stocks, and the stocks that have moved up are seeing some bit of profit booking. All right.
Shahina, stay with us. Interesting point of view coming in over there. Are we looking at this 1% correction too intently? Because let's face it, we are in the midst of overheated markets. Corrections and consolidation was always going to happen, wasn't it, Suyash?
And corrections and consolidations definitely needed to happen in the markets, which we saw a surge of in Nifty, we saw a surge of about 1,000 points in a matter of 7 days. So, as you rightly pointed out, correction was something that the markets was really hoping for, and consolidation was something that we're hoping for. And if we talk about the mid cap and the small cap space, Krishna, we are seeing that the participation has dropped down substantially. The number of stocks that were participating in the rally, the overall breadth has reduced. Not too many mid caps and the small caps stocks are participating. In fact, Shahina, I was looking at the trend in the mid cap and the small cap basket, and I was seeing, at least as per my analysis, there seems to be some sort of a divergence that is also playing out between the mid cap and the small caps. The mid caps have been underperforming in the past few sessions, whereas the small cap index has largely beaten the market. Do you see this divergence playing out?
Well, see, the small cap is always a very interesting space to be in. And what I have seen in my long career in the markets is that the most money is actually made in small caps, provided you've got your small caps correct. So this is a very difficult thing for retail investors to do, because unless you know what you're investing in, the company, the management, the integrity, the size of market, you can get very badly hit, and your small cap can just become a penny stock. So to that extent, if it's correct, then yes, small caps do outperform, but it's a very, very risky part of your portfolio. And I think mid caps is the space where normally, you can make decent amount of money, and which is where the retail investors in the last 1 year did come in full force. And even I would say institutions did, add on to the portfolios in mid caps. But now the rally has actually started, I would say, consolidating, because the stocks have moved up and the valuations have become, a bit expensive.
So perhaps time to once again look at the large caps, would you say?
I would say that large caps always has to be part of your portfolio. I mean, you cannot overlook the fact that while they may give you 10 to 15% return over 1 to 2 years, they are the liquid stocks. So if you are having investments, which when you have investments because you need the money sometime and you would like to have liquid investments. So to that extent, it is a must to have them. Only, it keeps changing. Like year by year, the large caps which need to be in your portfolio may change. So I'm not saying you buy your large cap and keep it forever, though some you may. They may be portfolio stocks. Like for example, now you have L&T, which is doing well, which is the large cap, which really didn't do well for quite some time. So there is a churn that takes place in large caps. Mid caps is something that you should invest in and then hold it for 2 to 3 years at least to get decent amount of returns. So to that extent, as of now, yes, large caps does look like the place to be in.
Now, Shahina, a lot of cues that you also mentioned earlier in the conversation, they all seem to be global cues. Any earning season is going to kickstart in a couple of weeks. What are your broader expectations from India Inc.'s Q2 report card?
Well, I'm not expecting too much. Couple of reasons. One of the large sectors like IT, while we're not expecting some very bad numbers, but in fact we are expecting it to bottom out in this quarter. So IT is not going to be something where you get very excited about by seeing the numbers. Then oil and gas, you see the crude oil prices. So this sector also is not likely to give you a very healthy sort of number in times of like stuff like OMCs. Also, you have elections that are going to come now. So to that extent, some of the agri product companies which are targeting the rural markets, there also you may see limited scope for price increases, or they would have to absorb some of the raw material price increases. Metals also, on a YOY basis, you cannot expect any substantial, great numbers. So I think overall, this quarter numbers is likely to be subdued, and the overall market is reflecting that. So I think the market for the next couple of months, maybe 3 months, quarter or so, will be in a mode of consolidation. So we should be happy if we remain between the 19,500 and 2,000 levels.
All right, consolidation mode. Fair enough. Clear call coming in over there for the next 3 months. Earnings, don't expect too much from corporate earnings. That's the call as far as broader markets are concerned. Suyash, we want to discuss the IT pack as well. But before we do that, let's just quickly get back to the day's trading session as well and talk about the big gainers and losers in the day's trading session.
Certainly, Krishna. So among the top gainers in the blue chip pack was Larsen & Toubro. Now, Larsen & Toubro touched a record high level. It broke past the 3,000 mark. Now, the trigger for the stock today was that UBS has raised a target price on the stock from about 3,040 to 3,600 rupees, which implies an upside of about 20% or so from today's closing. So that was a major trigger for the stock. And even if you see, the stock has been one of the outperformers this year. It has rallied about 44% year to date. In fact, in the last month or so, it has rallied about 10% or so. And its share buyback plan, which kicked in earlier this week, was also fully subscribed. They are buying back about 10,000 shares or so from the market, and it was fully subscribed. We saw good retail participation. So L&T is one of the stock that has been trending upwards slowly and steadily. Now, Bharti Airtel was another stock that was in the news today, and in fact it was among the top gainers. Bharti Airtel rose about 1.17% in today's trade. Now, this was on the back of Bharti Airtel adding 15.2 lakh new users in July compared to 14.1 lakh users back in June. Now, another gainer was ONGC. The stock was up 0.5%, and we are seeing in today's session we saw a rally in most oil stocks. ONGC was one, HPCL was another one. Now, this was on the back of a surge in crude prices, which bodes well for upstream company as it improves their revenue guidance and profitability visibility.
Right.
Now, another stock was Coal India. Coal India was up about 0.46%. The stock is at a nearer 6 or 7 year high currently. Power Grid Corporation also gained about 0.4%. This was on the back of expectations that the stock will get a lot of passive flows since NSE rejig is to take place today, and expectation is that Power Grid Corporation will see a lot of passive inflows from the stock. Now, among losers, Krishna, was Tech Mahindra. Tech Mahindra was down about 4% in today's trade. Now, as we were talking about, IT pack overall came under pressure, but Tech Mahindra took the worst hit. The stock was down, and in fact, if you look at the past 5-6 days, the stock has been on a run up. In fact, today it broke a 4-day winning streak, so perhaps we are seeing some sort of a profit booking taking place there. Another stock which was down today was Asian Paints. Asian Paints fell over 3.5%. Now, this was on the back of surge in crude prices, which is a major raw material for most paint companies. LTI Mindtree fell about 3%. Mahindra & Mahindra saw some profit booking taking place. It was down 2%. Wipro was also down 2% in today's trade.
Right. Both the Mahindra stocks, M&M and Tech Mahindra, they have run up in the recent past, and consolidation or profit booking, you would say, in both the Mahindra stocks, Suyash.
Exactly, that's what's playing out, Krishna, because the stocks were rallying at least in the past month or so. Mahindra & Mahindra, as we are seeing, there's some pressure because of the FIR that was filed, and Tech Mahindra also stock which was seeing a bit of a run up has also seen some profit booking taking place. But the the trend that we are picking up today is that most IT stocks saw some correction.
Absolutely.
And it seems that the view is largely divided on the IT pack.
Then takes us back to Shahina. Then a very good point. That's Suyash, we've been talking about Shahina. Look at the day's trading session. That's emblematic of what's been happening with the IT pack. You have the biggest loser, that's Tech Mahindra. You also have Wipro. Tell us your own view of what exactly is happening with these IT stocks.
Well, see, most of the large IT stocks have over 50% of their revenues coming in from US market actually. And if you see what is happening in the US market is that, and largely BFSI. Largely, there is a slowdown both in terms of the deals that these companies are signing, as well as a large part of the hiring or new orders, they're doing it locally, in the US market. So there is a bit of a slowdown in overall growth for the large IT companies. Also, the margins have seen a bit of a dip, and some of the large IT companies, like for example, Infosys, they have been actually bringing down their guidance quite substantially, and the growth for this year, this full FY24, is expected to be subdued because of all these reasons. So to that extent, the overall IT, which I would say should be part of your long-term portfolio, is seeing has actually not been part of many funds. It's not been a large part of their portfolio as of now. So to that extent, they may use this opportunity for the next couple of months to slowly chip in and buy some of IT stocks and some of the large ones, not expecting anything major in terms of earnings for the next couple of quarters. So to that extent, I think retail also can start buying slowly some of the large IT companies, because they are definitely good companies to hold in your long-term portfolio. But you don't need to rush in and buy now. You have all the time in the world. Take the next couple of months and add.
All right, so yeah, isn't it interesting, isn't it? The entire sea of red accounts, all sectors. IT pack only is the only sector that is down more than 2%. All of the sectors are down anywhere from 0.5% to 1.5%, 1%. But IT pack is the biggest of all losers even today.
Yes, and as Shahina also pointed out, that a lot of revenue that these companies generate comes from US, and we are seeing a turmoil brewing in the US economy. In fact, JP Morgan CEO Jamie Dimon recently said that US could be facing a stagflation sort of a situation.
Right.
We are hearing talks about a government shutdown in the US.
Right.
So a lot of headwinds for the global markets, especially for the US and European markets, given that interest rate regime is also expected to stay, interest rates are expected to stay higher for longer, and perhaps we can see another rate hike coming in November. So a lot of pressure building in the global market, especially for US, China and other European stocks. Now, talking about stocks, Shahina, L&T is one that has outperformed, has exceeded market expectations. Largely, the stock was also up about 2% or so in today's trade on the buy call from after UBS raised the target price. How do you see the stock after the recent run up? Would you still recommend perhaps adding position in the stock?
Well, I think I would prefer for it to cool down a bit, because the 3,200, the buyback price, I mean, it closed on September 25th, recent. So to that extent, this rally has, of course, to an extent been on back of that. Not to say that the sector is back in limelight, because of course L&T has got huge orders in its order book position is good. They are doing well both in the Middle East markets as well as domestic. The order pipeline is strong. So to that extent, it's a good buy. But at the same time, if you're a newer investor and you're looking to buy L&T, I would just wait for maybe a week or two, let the market overall settle down for L&T after the buyback, and then you can look to add it to your portfolio.
Another stock I wanted to touch on was Vedanta. Now, Vedanta outperformed the market today. In fact, it ended in green with about gains of 0.5%. In the morning trade, it was up 1%. Now, this rise came on the back of news that Vedanta could be looking at demerging some of its business into several listed entities. Now the stock is currently trading near its 14-month low or so. It has taken a beating, considering that the debt concerns relating to the company have been mounting. In fact, Moody's also downgraded the corporate family rating of Vedanta Resources, which is the parent company of Vedanta, yesterday. So what's your overall outlook on the stock? Can we expect some sort of a bounce back, given that the stock has corrected about 40% or so in a matter of few months?
I would classify Vedanta as a very high risk stock. I used to have a very negative call on the stock, and I still, wouldn't really recommend anyone to go and buy Vedanta, despite it having corrected. It is less to do with the business in terms of the opportunity. They are in oil, they are in zinc, they are in aluminium. So everything is doing well. But if you see the debt in the company, and you see the way the management has been continuously changing its strategy vis-a-vis India, once it's okay, we want to deal with this company and this business, and then this we will fund the debt from this, and the dividend that they pay is high, but it is basically eating into instead of repaying the debt, it's dividend. So to that extent, I would just stay away from Vedanta, though I think it's come off a lot. So if you are a very high risk trader, you can look at the technicals and trade.
high risk people only is the word coming in from Shahina Mukadam. Shahina, we can continue chatting on so many of these stocks and getting your perspectives, but I'm afraid we are running out of time here on the show. We have so much else to cover as well. But for now, thank you so much for taking time out to be with us here on Business Plus. Hope to keep having you on the show as often as possible going forward. But for now, we'll let go of you. And of course, Suyash, thank you so much as always for putting the day's market action and the situation that markets find themselves in into perspective. And with that, it's time for a very important programming note. The big show tonight at 10 p.m. on News 9 Live. Duologue. TV9's MD and CEO Barun Das in a candid conversation with business tycoon and philanthropist Mr. Narayana Murthy and his wife Sudha Murthy. Here, take a sneak peek.
Mr. Murthy, 25% of our population is below the age of 15. How do we make them involved in this growth story?
The leadership at all levels, in the country, they have to embrace good values, but it will still take some time.
I think we are not nurturing and leveraging 50% of our strength, which are the women.
Yeah, one of them has to step down and do that.
If you had donned the seat of chairman, maybe by now Oxford or Cambridge would have had chairwoman as a legitimate English word.
Duologue with Barun Das, featuring N.R. Narayana Murthy and Sudha Murthy. World premiere on Connected TV. Tonight at 10. Only on News9 Live. India's first and only digital exclusive English news stream for Connected TV. Supported by Alliance Broadband.
All right, make sure you tune into that at 10 p.m. only on News 9 Live. And that's 10 p.m. tonight. But here on the show on Business Plus, it's time to understand some interesting divergence that is happening as far as India's economy is concerned. FDI, foreign direct investment that is coming into India, is going down with every passing month and every passing quarter. But on the flip side, FII inflows, or the investment made by foreign institutional investors into India's stock markets, they are just soaring. In fact, when you take the numbers for the first quarter of the current financial year 2024 and compare it with the first quarter of the last financial year 2023, FII inflows have gone from minus and have gone all the way to double in the positive territory. Whereas that's the opposite as far as FDI is concerned. India, a country known for getting so much of FDI. What exactly is going on over there? Why is foreign direct investments into India on a downward spiral? To understand that, we have, first of all, my colleague and friend Karthik Malhotra joining us here in the studio, and also have our very special guest, Bidisha Ganguly, Chief Economist at CII, also joining us. Bidisha Ganguly, thank you so much for joining us on the broadcast. We will come to you quickly. We'll just put this into context. Karthik, the numbers are telling a divergent story over here.
Absolutely, Krishna. And I think not surprising, and honestly, I don't know whether we should rejoice with the current account deficit widening, or should we be worried that it may actually in the next quarter end up going back into double digits. So, that is one fear, because we are seeing the kind of oil shocks which are likely to come, oil inching towards the $100 per barrel, and at the same time the services sector not likely to recover on its upward trajectory anytime soon. And now talking about FDI and FII, I think on account of FDI specifically, this entire funding winter, the inflation and hence the rate hikes in the US making US T-bills more attractive, US bond market more attractive, has seen a lot of money that would have otherwise been pumped into Indian markets, not coming into Indian markets and really going into other investments like the T-bonds in the US. And that sort of, is the trick right now, which is playing out that on a year-to-year basis for Q1 of this financial year versus Q1 of the last financial year, we've seen FDI come almost to a third, from about $13 billion levels to just about $5 billion or so. FIIs on the other side are seeming to see the buoyancy of the Indian markets, and we have seen actually FIIs go up from a negative of 14 billion to a positive of about 15 billion. So that's in a nutshell what the RBI data released today suggests.
Right, and Bidisha Ganguly, if I can come to you, help put these numbers into perspective for us. One is the fact that FDI inflows coming in is a factor of so many things, but FII inflows, seeing this spike, is it a case that, India's stock markets are a better brand than the Indian economy, so to speak?
Thank you for having me. So, I think to put these numbers in context, it's we should not look at just the Q1 of last year and Q1 of this year. We have to look at the trend through the quarters of the year. And, if FDI in Q1 of last year was exceptionally high, since then it has fallen and has been in the range of $5 to $6 billion through Q2 FY23, Q3, Q4, as well as Q1. That's the range that we've seen. And this is during this period that there's been a slowdown in the global economy, and FDI globally has been fairly moderate. So that is the reason why FDI has been coming down. Probably going forward, we will see an increase in FDI, given that India has been making a lot of efforts, and we know that many of these efforts have been fruitful, like getting FDI in, say, the electronics sector. We know that Apple is investing, other companies, Samsung, etc. The electronics sector has been getting a lot of investment. So probably going forward, we might see a recovery in this FDI. FII, on the other hand, is extremely volatile, has always been volatile, and a big increase in first quarter may not be followed by continued increases in the subsequent quarters. In fact, the current global scenario is such that US interest rates are increasing, and therefore a lot of money could go into the US bond markets where the yields are high, and we might see a reversal in the FII inflows, although I must point out that the inclusion of the Indian bonds in the global bond indexes has come at a good time, and in anticipation of the inclusion, we might see some portfolio inflows into the bond markets, and that could keep the FII number strong.
Vidisha, if I can come in here. Hi, thanks for joining us here this afternoon. Just want to get your input on the surging crude prices and inching closer towards the $100 billion mark. Is that something that the trade would have factored in already? And if not, what's the kind of impact on current account deficit that we could see in subsequent quarters?
That is indeed a concern. India is susceptible to rising crude prices. Whenever that happens, our current account deficit goes up. So it's good that in this quarter it has been under control. Earlier we had concerns of the full year CAD going up beyond 2%. However, we have been able to keep it at 2% in FY23. And FY24, we will certainly have a problem because exports are also not too healthy. They are moderating, and that is again driven by global trends. So we really need to focus on keeping FDI flowing, keeping FII also flowing, so that the higher current account deficit is matched by good capital inflows.
Okay, but this surging oil prices is also likely to impact or rather further put pressure on the Indian rupee, and that while it would make services a little more lucrative than they are right now, but manufacturing could be a very different story.
Yes, there is already, we are seeing pressure on the Indian rupee. And yes, if the current account deficit goes up, but ultimately it's the overall balance that matters. If current account deficit is going up, but capital inflows are matching it, then the rupee could remain stable at current levels.
But is data suggesting, Ms. Ganguly, that we are actually seeing capital investments coming in? Because the PLI scheme, despite the best efforts put in by the government, and in the IT hardware space particularly, where we really want to pin our hopes on the manufacturing story of India to shine, we haven't really seen much action yet. And IT hardware is, of course, something which is new, and hopefully in a week's time or so, we should have a list of companies which do get the PLI approval. But we haven't really seen investment take off with respect to PLI, despite a large corpus of 1.97 lakh crores allocated towards PLI.
I think corporates are fairly bullish on this, and they are looking at investing. It takes a while. And there's also we should not bank only on PLI. The whole story that the government is investing in infrastructure, that is certainly happening. and that will make companies more competitive. They're improving on their quality. So that whole story will take a while to play out, but it is certainly happening. I don't think we can say that in whatever surveys we do, for example, all companies say that they are increasing their investments.
But what are the talks in the corporate circles, ma'am, since you work with industry leaders in your capacity at CII very closely? What are the talks in the circles? Do we assume right now that given it's election year, we can't afford the GDP numbers to slip? The government can't afford it, should not afford it for the sake of the population and the vote bank as well. But who's going to do the heavy lifting when it comes to GDP numbers in this financial year? Is it going to be government capex, which will continue to be a major contributor to overall GDP growth, or the animal spirits of corporate India that we keep talking about, is that going to be equally in charge of the GDP numbers?
So if you're talking about GDP growth, I would say, consumption is the biggest driver, and that has to pick up. And if consumption picks up, there is no, corporate investment will certainly follow. Because that's really what drives the corporate India. There is a huge amount of latent consumption in the country. Rural consumption, which was earlier muted, we have seen a pickup in rural consumption over the last few quarters. Of course, inflation is a dampener. Hopefully, inflation will moderate, and that will give further. The festival season is coming up, and that is a big hope for consumption boom. As far as corporate investment is concerned, I think capacity utilization levels are at 75 to 100%, and they have consistently been at that level for the past few quarters, which bodes well for private investment to pick up.
Okay, ma'am, if I can just jump the gun and come to another issue which has really been in news recently, and that is to do with this so-called retrospective or non-retrospective clarified GST on gaming companies of all kinds. That is something which is likely to impact sentiment of new age industry to sort of make entry into India and for it to pick up scale. Do you think these changes in the GST regime, or the sort of lack of clarity or lack of proper communication on the tax norms, is something that India needs to iron out, and iron out really quickly to really help the FDI story pick up?
Certainly, you're right. These things need to be ironed out, and there needs to be tax certainty. That is for sure. But a bigger issue in GST, I would point out, is its rationalization by inclusion of all the exempted categories, like fuel. If that is included, that would really give a boost to the GDP overall. I mean, there are sectoral issues across. I'm sure they are. These sectors are taking it up with the ministry, and ministry is having a look at it. But the big issue is that inclusion of all products in GST, and that would really give a boost to the economy.
All right, Bidisha Ganguly, Chief Economist of the CII, they're bringing that all-important perspective on data that's seemingly confusing. But of course, when put into context, makes a lot of sense, and also helping us understand the way forward as far as India's economy and investments into India is concerned. Bidisha Ganguly, lovely having you on the show. Thank you so much for taking time out to share your perspectives with us here on Business Plus. Hope to keep having you on the show again and again. But for now, we'll let go of you. Thank you so much for being with us.
Thank you.
Right, and Karthik, with that, you were talking about gaming companies, even as we were discussing all these data numbers about FIRs and FDIs, talking about gaming companies and online companies per se. And one of the most famous versions of online companies, apart from gaming companies, are companies that we use on a daily basis. Netflix and Amazon and Spotify and all these OTT players, OTT content service providers, they are possibly going to find their GST compliance now absolutely airtight, because that's what the government is trying to do, Karthik, in terms of making sure that every single service provided by them on the Indian soil to anybody, registered GST individuals or not, all of them will be taxed at 18%. But Karthik, we were just checking your own last month's Netflix bill.
I hope we can pull up those those visuals of my invoices which I have been paying. So
don't we already pay 18% GST?
18%. I mean, I checked 3 services that I subscribed to.
Right.
Netflix already charges 18% IGST, and I'm a GST registered individual user. I think what the government is trying to do, and in fact what the reports are suggesting this morning, is that government wants to make it airtight for the for services which are in the realm of OTT, to individuals, to state governments, to central governments, GST compliant. But to my mind, most of these services, I looked at Netflix, I looked at YouTube, I looked at Apple, and all three of them, and Apple, I don't mean the hardware, the phone, the Apple services of data that I subscribe to use the 200 GB of data every year, I am already charged 18% GST. So my simple question is, Krishna, and I don't have an answer to it, it's a question that what changes? Is there any impact to people like you and me who are already subscribing to these services and paying an 18% GST?
Right, it is online information and database and services. We have Dr. C.A. Abhishek Murali, President, All India Taxpayers Association, and Secretary, SIRC of ICAI 2020-2021, now joining us. Thank you so much for taking time out to be with us, Mr. Abhishek Murali. Demystify this for us. Kartik and I went through our own Netflix bills. There was 18% GST already on it. Now comes this new clarification about how, if an unregistered people, if those services go to, they were exempt before, but they are not exempt anymore. But we were unregistered, but we are still paying GST. Can you please demystify for us what exactly is going on when it comes to GST on online services? They have their entire definition of OIDAR.
Look, the objective of the government is basically now, with the advent of technology, with the advent of the internet in the way that it is today, it's so easy to consume information that you don't know where it comes from. And a big challenge that is the case for especially tax authorities, whether it is income tax or GST, is that locating who is giving the service. Today, I can set up a server anywhere across the world and I can supply to anyone across the world. So therefore, while Netflix and Apple is a low-hanging fruit, I can say, because that's something which is very common and almost everyone uses it. So straight away we think about that. But there are a lot of services, companies that give, anime is consumed very largely in many parts of India. There's a niche audience for that in India. And there's not really any great provider of this service, which is either Netflix or Prime or Amazon, all of these people who are supplying their OTT platforms. Some of these are not available in the large quantity that people who follow it want. So now they subscribe to a certain Japanese company or maybe an American company, etc. So there is a consumption of the service. So it is happening. It's not that it doesn't happen. It is happening. And what is happening is these people are providing the service against Indian consumers or other Indian service providers who are not able to do it at the same rate that these guys get it. So how is it fair if News 9 has to pay 18% GST and Al Jazeera is sitting somewhere across the world and they're able to supply the same service without having to pay GST?
Right.
So I think
Abhishek Murali, what we're trying to understand here is that you have these. We understand that this GST is on foreign players providing online services here on Indian soil. So you have the likes, the major ones already, whichever bill you pay, Apple or Netflix already, where you're paying 18%. The question I'm asking is that there is an entire distinction between providing for business purposes and personal purposes. If you provide it on personal purposes, you're exempt. You were exempt before, but now you're not going to be exempt. I'm just trying to understand, does the GST liability from the customer's end or from Netflix's end go up, and consequently the price charged to the customer go up? Is there a possibility for that, or are we already paying, at least for the major OTT services, major online services that we use, as customers were already used to paying 18% GST? My simple point is that liability going to rise any further?
It's unlikely unless Netflix or whoever is the service provider decides to rack on the prices onto this. So in fact, the largely consumed OTT platforms, I think there'll be no major change for you in terms of your pricing, what you're paying today. But this is an amendment which is brought into effect so that there's any leakages where somebody is supplying a significant amount of content for consumption. In order to protect the Indian Revenue Authority's collection, that's why they're doing it. Because how does the government verify whether it's for personal consumption or a business?
Agreed.
If it's a GST,
Abhishek, if I can just come in here, for the sake of time as well as your time as well as, the air time that we have available, I just, want to understand, is it absolutely necessary for a foreign OTT service provider, we'll call it OTT for the sake of simplicity, for a foreign OTT house to also set up an Indian subsidiary to be able to charge this GST? Otherwise, wouldn't it lead to some sort of a duplication of tax or a double taxation, because they would be paying tax in the country where they are providing a service as well as paying tax in the host country where they are housed. So what changes for these OTT service providers? Do all of them now need to necessarily have an Indian subsidiary as well?
Well, so this is where the interesting point comes in. Majority of these companies are set up in places where there's no tax, or they hardly pay any tax.
Absolutely.
So the whole point is that they're paying no tax, and yet they're earning income from people across the world. So as far as India is concerned, demographically we're placed, in a good position right now. So whatever tax collection, what you're earning out of our country needs to be collected to our country. So ultimately the point, coming back to the previous question, is our charges going to go up? It may not go up for the main services, it may go up for some others, but I think that's a commercial decision. So if the service provider feels that Indian customers are so important, they're price sensitive, if I increase it by 18%, I lose them, then they need to, make do with, modifying their prices to include the GST or something. But as far as consumers, yes, there may be some services which are going to cost more, but that's ultimately your decision commercially whether you want to do it or not.
All right, Abhishek Murali there joining us with the latest on that perspective, helping us decode and demystify what exactly is going on with the GST on all kinds of online service providers. Thank you, Abhishek Murali, for taking time out to be with us here on Business Plus. Karthik, I'm afraid we've completely run out of time here on the show. But before we wrap things up, a quick news that's coming in as we began the show.
Absolutely. News just coming in. Krishna Ashwin Dani, he's died at the age of 79. He was the non-executive director of Asian Paints, and a billionaire, of course. Ashwin Dani, who was the non-executive director of Asian Paints, has died.
In fact, son of one of the founders of Asian Paints.
Absolutely, and he joined the company back in 1968.
Yeah.
And has served, of course, his entire life serving Asian Paints, making our houses beautiful. And what a glorious life he lived.
And what a glorious corporate career, 3 to 4 decade-long corporate career that really, painted the country in all kinds of colors, the homes of this country in all kinds of colors. Rest in peace, Ashwin Dani is all we can say at this stage. But we wrap up this edition of Business Plus on that somber note. Thank you so much for watching. This is Krishna Kumar signing off.
Mr. Murthy, 25% of our population is below the age of 15. How do we make them involved in this growth story?
The leadership at all levels, in the country, they have to embrace good values, but it will still take some time.
I think we are not nurturing and leveraging 50% of our strength, which are the women.
Yeah, one of them has to step down and do that.
If you had donned the seat of chairman, maybe by now Oxford or Cambridge would have had chairwoman as a legitimate English word.
Duologue with Barun Das, featuring N.R. Narayanamurthy and Sudha Murthy. World premiere on Connected TV. Tonight at 10. Only on Newsline Live, India's first and only digital exclusive English news stream for Connected TV. Supported by Alliance Broadband.
Heart Matters. Watch day-long coverage. A World Heart Day special. September 29th on Newsline Live.
3 years after the deadly Galwan clashes, India has doubled the pace of infrastructure creation on the border. India's Border Road Organization is accomplishing Mission Impossible, creating infrastructure to secure us from our foes across the Himalayas.
Look at China. They don't have to climb up like us. Once they are on the Tibetan plateau, the construction work, the maintenance work, everything is fairly easy.
on India's 77th